Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex.
Chicago soybeans. I drew 9 weeks ago an early July to mid-November 2023 bearish Andrews pitchfork, which is highlighted in purple on my daily chart. At the time, it was more as a way of expressing the bearish angle of attack here than for anything else. And in this, it's been accurate in showing the way lower and the bearish angle of attack, especially in the middle of the March, where I draw your attention to the high at 1240, which briefly touched the descending upper time, currently at 1203. Since then, the market's traveled roughly parallel to the upper time, enough that I drew today a fresh mid-November 2023 to mid-March 2024 bearish Andrews pitchfork, highlighted in bright red on my daily chart. In this one, the market is at a slightly steeper bearish angle of attack, but the market is still running parallel to this new upper time, currently 1186, which is close to the slowly descending green highlighted short medium moving average, currently at 1184. The turn up at the end of February, stroke beginning of March, was both surprising and amazing, as we really had no further support below until the 61.8% absolute Fibonacci line at 1106. So from the December 2020 low, prices turned back up, pushing through congestion in the 1161 area, then 1161 to 1177, the 2021 low at 1181, the May 2023 low at 1193, and the December 2021 low at 1223. Perhaps most important of all, prices pushed up through the green, slowly declining short medium moving average. And for a couple of weeks, the market used it as support, with the purple upper time as resistance. However, 2 weeks ago, prices started penetrating the short medium moving average on the downside, and also the May 2023 low at 1193, the 2021 low at 1181, and the lesser Fibonacci line at 1178, and the start of the previously mentioned congestion, 1177 to 1161, that overall stopped the decline just over a month ago. Well, this week the market pushed down below it, but at the moment it's having a bit of trouble closing, not penetrating, but closing below it. May not have it tonight, but we'll see. To add to the discussion, I spoke the following 5 weeks ago, and I quote, "One thing such a move higher might start is discussion if the November 2023 today action is a potential descending scallop pattern. The only other thing to bear in mind is not here on this daily chart, but in Chicago soybean meal, and that is the well-highlighted annual key reversal down we saw for 2023 there. Not directly related here, but not worth ignoring either," and that's the end of the quote. On the point of the descending scallop pattern, if prices were to continue lower, down to the 1130 area, and then hesitate before breaking further down, well, that would fit in with the pattern. The alternative is almost an immediate return higher and a quick break, a proper break of the purple upper time right now. And right now, that does not look possible. Chicago soybean meal. After establishing a horn top in mid-November 2023, prices dropped with some hesitations and eventually reached the congestion down at 326.90 in late February this year. However, this congestion was different compared to the early ones, as we had crossing through it at the time the extension to the lower trend line, currently 326.90, of the July to September 2021 descending triangle. Now, I've highlighted this trend line in dark blue on my daily chart. As I said 7 weeks ago, and I quote, "This may be nothing, but I am minded after such a fall as we've seen since November last year that this may see some hesitation around the 327 to 325 zone. I'm not certain on that, but it's worth considering. However, the overall pressure is still bearish, end of quote. Well, prices utilized the extension of the descending triangle as a base and rallied back up through the 61.8% absolute Fibonacci line at 336.30 and even briefly over the green highlighted short medium moving average, currently 338.70, before succumbing to the bearish pressure this moving average exerted. This seemingly defines where we can see the topside pressure coming from, the slowly declining short medium moving average. For a while, mainly during March, it looked like all this was within a very recent and possibly larger pattern, a March-based bull channel. But that proved to be a mirage. Instead, I've drawn a very early February to date sideways triangle highlighted in bright red on my daily chart. And that's currently 331.80 to 342.20. We are quite advanced along the coil of this triangle, so the propensity for there to be false breaks in either direction is quite high. So watch out for that. It's also, even now, a little too early to give targets, but I can give an idea of the size of the moves in either direction. Thus, a confirmed break higher would have a primary target of US dollars 21.90 above the break, and a secondary harder to reach target of US dollars $42 above the break. Similarly, a confirmed break lower would have a primary target of US dollars $15.10 below the break and a secondary harder to reach target of US dollars $42 below the break. Please be aware that data indicates that markets break upwards 6 out of 10 times from sideways triangles. Finally, I will raise once again the one key feature I need to repeat and emphasize. As I have done so in the past, I raised it as a possible feature 44 weeks ago, and it came to fruition at the close of 2023. It was that the whole of 2023 was an annual key reversal down last year. This hangs over all of this market more than anything right now, and all action should be seen in the shadow of this pattern. Chicago soybean oil. At the turn of the year, the market broke down through the 38.2% Fibonacci line at 48.95 that held up prices over November and December last year. At that time, it looked as if the market might form a very extensive bearish halfway hesitation, with potential being as low as possibly below $40. 40 cents, I should actually say, it's not dollars, is it? However, the decline was a lot shallower than in previous moves lower. This was possibly dictated on top at the time by the green highlighted short medium moving average, currently 47.10. Prices went down to the area of the congestion we last saw in May 2023, consisting of 3, possibly 4 bands. They were and are 44.68 to 45.04, made up of the 2014 high at 45.04 and the May 2023 low at 44.68. Then the tight 43.80 to 43.94 zone, made up of the 50% absolute Fibonacci line at 43.80 and the April 2014 high at 43.94. Then the interesting 42.65 congestion, which has the neckline highlighted in bright red, of the October 2019 to February 2020 head and shoulders top running just above it, and that's currently at 43.30. I mention all of these because some 41 weeks ago and numerous times since, I said the following about the big descending wedge pattern that was on my daily chart back then and is now high up off the top of my chart. I said the following, and I quote, "I would consider this descending wedge pattern may, just may, have lately morphed into a possible scallop pattern," end of quote. Now this is a big pattern idea, and the market decline since autumn of last year fits in with this idea, with the expectations I voiced of eventually witnessing a fall down to the area of the May and June lows between 48 even to 46 even, which is where we've recently been and where we are again today. I've often stated here that I'm keeping a very, very close eye on this idea, as any significant break below the 48 to 46 zone could signal the start of the rest of this move lower. Now, I said 6 weeks ago, and I quote, "So far I'm not convinced of the move that we've seen this break lower already. No, not just yet." However, 3 things to bear in mind. Firstly, this is a really big pattern stretching from November 2022 to date, so do not expect any immediate sharp movements. Secondly, data indicates about 3 out of 4 times the market breaks lower. Just be aware of that. Thirdly and finally, I would like to float the idea of a recent unusual bear channel. End of quote. Now, I've highlighted a bear channel dating from the start of 2023 in dark blue on my daily chart. And that's currently 41.58 to 47.11. I had for a while utilized the green short medium moving average as the upper bear channel line before I drew a proper trend line. Upper trend line. So it was that 5 weeks ago prices punched up through the short medium moving average, the first time closing over it since June last year. What is more, the market continued the rise and also punched up and closed over the upper bear channel line, the 38.2% Fibonacci line of the March 2020 April 2022 move at 48.95, and also the mauve highlighted slowly declining medium moving average, currently 48.03. However, this was too much for the rise, and the additional forces mustered by the significant 38.2% Fibonacci line, the March 2020 to April 2022 move at 48.95, plus the congestion area seen in December last year between 49 even to 51.25, eroded the move higher, despite consecutive closes over both the medium moving average and the 38.2% Fibonacci line. Enough that last week we saw the market close down below the 38.2 Fibonacci line, below the mauve-colored medium moving average, back within the dark blue highlighted bear channel, and back below the green highlighted short medium moving average. Okay, so I said 3 weeks ago about moves higher, and I quote, "So, last time I thought there might be sufficient ammunition below to take on this overhead congestion should the market choose to do so. However, this is a question that's still open. Nearly 3 weeks, so that's actually 6 weeks ago, nearly 3 weeks after the market started tackling it. And the longer it takes, the less likely is the result positive." And that's the end of the quote. Now this brings me once again back to the recent bear channel in dark blue. 4 weeks ago I laid out some potential targets overhead for a break of this pattern. I quote, "So a primary target X would be in the 49.65 area, an area that we've almost reached, with a secondary hard to reach target X1 up in the 51.95 area." End of quote. Well, the market reached the primary target of 49.65 and reached it again, and almost a third time. But prices have dipped, and we're far away from it now. It's still an open question as to whether the market will reside back within the bear channel or just ride along the top side of it, or especially of the slowly declining upper bear channel line, currently at 47.11. Though the move to reside back within the bear channel has a much stronger case now. I said 3 weeks ago, and I quote, "In 2 weeks or so that's actually 6 weeks ago, we may see the flatlining green short medium moving average start interacting with the upper bear channel line, and it'll be interesting to see what happens next. For the moment, I will leave target X1, the secondary hard to reach target, up at 51.95. I make no assurances as to whether I will keep it there or not." End of quote. Right now, the chances of it being there next week are greatly diminished. One final point, as an observation I made 3 weeks ago, rather than a definitive point. For some reason, I saw the beginnings of a possible reverse head and shoulders pattern developing this year. We've been playing around with forming a possible second shoulder. Well, this has not gone well, and I will hold off any idea of a reverse head and shoulders pattern, whether it be a traditional bullish reverse or even a rarer bearish continuation pattern, for now.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.